This is a fantastic article, and you say the key to the Amazon puzzle is asset turns. Tell us what asset turns is and how Amazon compares and contrasts with Google.
Well, asset turns are just the ratio of sales over the long-term assets that you have and are employing. So it's in a way kind of a measure of productivity, if you will, of the capital that you have employed. And what's been happening with Amazon, it really is an interesting puzzle, because you've got margins that are shrinking, and you've got meager profits, and yet the stock is up about 65% this year. And the reason why, you have to focus on the asset turns, but you have to go back to the basics, and that is that they've been investing a huge amount of money in capital expenditures. Capital expenditures over the last 5 years have gone up about 7 times, almost 7 times actually, in 5 years. So you've had this huge growth in capital, and you say, well, what are they doing with all this? And what they're doing is they have a platform that delivers their 3 basic elements of sales, that they're things that they produce. And that platform, to add to it, you have to add big chunks of capacity. And when you add big chunks of capacity, of course, you're not using them all right away. So as a result, the asset turns go down.
I see.
And when the asset turns go down, the margins go down, and then the rate of return on invested capital goes down. But what the market seems to be seeing is that Jeff Bezos knows what he's doing. He's adding the optimal amount of capacity. Even though it's temporarily unused, it will become used. And as it becomes used, the asset turns will shoot up, and the margin improvement will be very great. We've done some work on the margins, and the relationship between the asset turns and margins is very elastic. So if you get a 1 percentage point improvement in asset turns, you get almost a 4% improvement in the margins.
So it sounds like it's a leading indicator for margins, these asset turns. I wonder, Professor Henke, Jeff Bezos owns 18% of the company. If you take a look inside my Bloomberg terminal, we've broken down their shareholder structure of this company, the ownership. His 18% stake is more than double the next biggest shareholder, Capital Group. Why is that important when you look at Amazon compared to, say, Google? Very quickly here.
Well, very quickly is that he's incentivized to do the right thing. He makes money when the stock goes up, and he makes money when he invests optimally in capacity. And so he's been spending a lot on CapEx over the last 5 years. You would think that he would know what he was doing, because he's got his own skin in the game.
Right,
everything is basically rigged and incentivized, so he's doing exactly what the shareholder should want, and that's stock going up.